The SPDR S&P 500 ETF, ticker symbol SPY, is one of the most popular and widely traded financial instruments in the world. It tracks the performance of the S&P 500 index, which represents 500 of the largest publicly traded companies in the United States. Trading SPY can offer significant opportunities for both short-term and long-term investors due to its liquidity, diversification, and alignment with the overall market performance. However, as with all forms of trading and investing, there are risks involved, and it's crucial to approach it with a well-informed and disciplined strategy. This guide aims to provide an in-depth overview of trading SPY, emphasizing the importance of a smart mindset, long-term perspective, and patience. Additionally, please note that this information is for educational purposes only and does not constitute financial advice. You are solely responsible for your trading decisions, and we are not liable for any gains or losses incurred. Always consult with a licensed financial advisor or do thorough research before making investment decisions. Understanding SPY. The basics. SPY is an exchange-traded fund, or ETF, designed to track the performance of the S&P 500 index. This index is considered one of the most accurate representations of the overall U.S. stock market because it includes companies from a wide range of sectors, such as technology, healthcare, financial services, and consumer goods. As an ETF, SPY allows traders and investors to gain exposure to the entire S&P 500 without having to purchase individual stocks. Key characteristics of SPY. Diversification. SPY offers immediate diversification across 500 companies, reducing the risk associated with individual stock investments. This makes it a popular choice for both novice and experienced traders who want exposure to the broad U.S. stock market. Liquidity. SPY is one of the most liquid financial instruments in the world, with massive trading volume. This means that trades can be executed quickly and at narrow bid-ask spreads, making it ideal for both short-term traders and long-term investors. Expense ratio. SPY has a low expense ratio, meaning the cost of holding the ETF over time is minimal. As of 2023, the expense ratio is 0.09%, making it cost-effective compared to many mutual funds. Dividends. SPY pays dividends based on the earnings of the companies within the S&P 500. These dividends are distributed quarterly and can be reinvested to compound growth over time. Why trade SPY? SPY offers a range of benefits that make it an attractive option for traders looking to capitalize on movements in the overall stock market. However, it's important to understand why traders choose SPY and what advantages it offers over other financial instruments. Advantages of trading SPY. Broad market exposure. By trading SPY, you're effectively trading the performance of the U.S. stock market as a whole. This can be less risky than trading individual stocks, as the ETF is diversified across multiple sectors and industries. Volatility and volume. SPY has high trading volume and moderate volatility, which makes it ideal for both day traders and swing traders. The liquidity ensures that traders can enter and exit positions quickly, while the volatility provides opportunities for profit in both upward and downward markets. Ease of trading. SPY is highly liquid, and trades can be executed quickly at favorable prices. This makes it easier for traders to manage risk and take advantage of price movements in real time. Leverage and options. For more advanced traders, SPY offers options trading and leverage through margin accounts. This can amplify returns, though it also amplifies risk and provides more flexibility in managing trades. Risks of trading. SPY. Market risk. Since SPY tracks the performance of the overall market, it is subject to the same risks as the stock market itself. In the event of a market downturn, SPY will decline in value along with the S&P 500 index. Volatility. While SPY is relatively less volatile than individual stocks, it can still experience sharp price movements, especially during periods of economic uncertainty or significant geopolitical events. Overconfidence in diversification. Although SPY offers diversification, it is still tied to the U.S. economy. A significant economic downturn in the U.S. would negatively impact the entire index. It's essential to understand that diversification within a single country or market doesn't eliminate risk entirely. Trading strategies for SPY. There are multiple ways to trade SPY depending on your risk tolerance, time horizon, and investment goals. Below, we'll cover some of the most common strategies employed by traders. Day trading involves buying and selling SPY within the same trading day, aiming to capitalize on short-term price fluctuations. Given SPY's high liquidity and frequent price movements, it is an excellent candidate for day traders who use technical analysis and charts to make quick decisions. Key aspects of day trading. SPY include technical indicators. Common technical indicators used for day trading. SPY include moving averages, relative strength index, and Bollinger Bands. These tools help traders identify potential entry and exit points based on price patterns and momentum. Risk management. Day traders typically use stop-loss orders to limit their downside risk in case a trade moves against them. Setting clear profit targets and adhering to a disciplined exit strategy is crucial for success. Quick decision-making day trading requires fast decision-making and the ability to react to market news or price movements within minutes. Traders must constantly monitor their positions and be prepared to exit trades swiftly if conditions change. Swing trading involves holding SPY positions for several days or weeks to capitalize on medium-term price trends. This strategy requires less constant monitoring than day trading, but still involves frequent trading based on technical analysis and market sentiment. Key aspects of swing trading. SPY include trend identification. Swing traders use trend lines, support and resistance levels, and chart patterns like head and shoulders or triangles to identify potential price movements over the coming days or weeks. News-based trading market sentiment and news events, such as earnings reports, Federal Reserve announcements, or geopolitical developments, can have a significant impact on SPY. Swing traders may enter trades based on their anticipation of how these events will influence market movements. Risk-reward ratios. Swing traders typically look for trades with favorable risk-reward ratios, meaning the potential upside is much greater than the downside risk. Stop-loss and take-profit levels are usually set in advance to manage risk. For long-term investors, SPY serves as a simple and efficient way to gain exposure to the U.S. stock market. Rather than trying to time the market, long-term investors focus on buying and holding SPY for years or even decades, allowing the power of compound growth and dividends to build wealth over time. Key aspects of long-term investing in SPY include buy and hold strategy. Investors who believe in the long-term growth of the U.S. economy may choose to buy SPY and hold it without worrying about short-term fluctuations. Over time, the overall upward trend of the stock market has rewarded long-term investors. Dollar cost averaging. This strategy involves investing a fixed amount of money into SPY at regular intervals, like monthly or quarterly, regardless of the current price. Dollar cost averaging reduces the impact of market volatility and ensures that you continue to accumulate shares over time. Reinvesting dividends. By reinvesting dividends, long-term investors can compound their gains over time. Many brokerages offer automatic dividend reinvestment programs that make this process easy and efficient. Options trading with SPY is a more advanced strategy that allows traders to speculate on the future price movement of SPY without owning the underlying asset. Options contracts give traders the right, but not the obligation, to buy or sell SPY at a specified price, known as the strike price, by a certain date. Key aspects of options trading with SPY include call options and put options. A call option gives the trader the right to buy SPY at the strike price, while a put option gives the trader the right to sell SPY at the strike price. Traders use options to hedge their positions or speculate on price movements with limited risk. Leverage is another important factor. Options allow traders to control a larger position with a smaller amount of capital, amplifying potential returns. However, this also increases risk, as options can expire worthless if the price moves against the trader's position. Risk management is crucial in options trading. Traders must carefully manage their risk by using strategies like protective puts, covered calls, and stop-loss orders. Given the complexity of options, it's essential to fully understand how they work before engaging in options trading. Factors that influence SPY's price. Several factors influence the price movements of SPY, and traders must stay informed about these drivers to make educated decisions. Economic data. Economic reports such as gross domestic product growth, employment numbers, inflation data, and consumer confidence can have a significant impact on SPY. Positive economic data generally boosts the stock market, while negative data can cause the market to decline. Federal Reserve policy. The Federal Reserve's decisions on interest rates and monetary policy play a critical role in the stock market. When the Fed raises interest rates, it can lead to lower stock prices as borrowing costs increase. Conversely, rate cuts and accommodative policies tend to boost stock prices.